Hello, everybody. Good morning. This is Brandy Terwilliger with Maynard Costerisan. I'm a tax partner here, and co-presenting today will be Madeline Henry, who is a manager here in our tax department also. Just wanted to welcome you all to the webinar today. We have a lot of information to go over, so if you have follow-up questions that you want to email either one of us and ask, our emails are the bottom of the first slide. Feel free to do that. And so with that, I think we'll get started on tax reform and how it's going to affect your not-for-profit organization. So today we're going to cover a lot of items. We're going to talk about what did not change in tax reform, because I know there's a few things that we were hoping wouldn't change and they didn't, but we will go through those items. We're going to talk about the impact to charitable giving, how to talk to your donors about the changes in the tax law, the changes to unrelated business income tax, different taxation, excise taxes on compensation and excise taxes on college and university endowments. We'll talk about some changes with the fringe benefits and possible taxation in that area, and then a few other items that pertain to more of the corporate atmosphere, but how it can affect your 990T or wholly owned subsidiary. So what didn't change? Big one is the taxation of royalties. So this provision was originally in the Senate bill, but was removed after a lot of opposition by hundreds of associations. This is normally when you are receiving royalties for a licensing agreement to use your name or logo, and that you're not also actively involved in the marketing or administration of that product or service. Many of our organizations have this, so we're very excited the fact that this is not going to be taxed at this time. Definitely, this is a huge source of non-dues revenue, so keep this in mind though, being as it was brought up in this tax reform, it kind of worries me that it could be brought up in the future. But for now, we're safe. The elimination of the rebuttable presumption of reasonableness, this kind of goes along with the fifth one down about the intermediate sanctions. But what this is shifting that burden of proof of unreasonable compensation. Currently, that burden of proof is on the IRS if the organization is doing certain things to make sure that their comp is reasonable. I'm not going to go through all of those items, but for the most part, most of our organizations do that. And so what that does is that shifts the proof to the IRS, and they were going to eliminate that to where that proof would have to come from the organization, but luckily they did not. They were going to eliminate the estate tax. That was not done, but they did double the exemption, which we'll talk about in a minute. They were going to repeal the Johnson Amendment. This is the amendment that would have enabled churches or other 501c3 organizations to participate or intervene in political campaigns. This was not repealed, so that is still in place. And as I mentioned earlier, they were going to expand the reach of intermediate sanctions to labor organizations and business leagues. And so this is transactions that inure to the benefit of a disqualified person in an organization. And these usually affect your charitable organizations. And we're happy that it did not reach out to the labor organizations. Also, an expansion of the definition of disqualified person. There's a lot of things in that definition, on what a disqualified person is. And if you need help determining that, we're happy to help you with that. But they were going to expand that to include more individuals, but luckily they did not. There was going to be some additional reporting for supporting organizations. We already have quite a few pages in the Schedule A to have to report why an organization is a supporting organization and what type. So we were very happy to see that there wouldn't be additional reporting in regards to that. The private foundation tax, they had thought that they would reduce it to a single rate of 1.4%. Currently, it is either 1% or 2%, depending on your distributions, your qualified distributions. It's staying with that 1 or 2%. And then non-qualified deferred comp plans. There was some talk in the act that would have eliminated 457 plans for associations and other not-for-profit employers. This is a very important benefit to not-for-profits to attract top talent, since they can't offer other types of performance stock options. So we were happy to see that this was not in the act. So how does tax reform affect charitable giving? This has been a big talk in the news about what's going to happen with the giving of individuals and what people are going to do in regards to a lot of the changes. So one of the things that has been talked about is the increase in the standard deduction. So this nearly doubles the standard deduction. So there's going to be less people who are going to be itemizing their deductions this year on their 1040s. So many not-for-profits fear that it could lead to a reduction in overall giving. Change in the ordinary income tax rates, though, I think that this could actually do the opposite. Those people who have that already giving nature to them may actually have more disposable income if their tax rates have went down, and they may be able to give more to charitable organizations. The estate and gift tax. So this was doubled. The gift and estate tax exemptions doubled from $5 to $10 million. This could significantly reduce the incentive for people, especially the wealthy, to make charitable contributions because more of the property can now be transferred to their beneficiaries tax-free. And some of the changes in itemized deductions that could affect charitable giving, the state and local tax deduction. So for those who can itemize, this will be limited to $10,000 in total. So that's your property taxes, your state income taxes, and local income taxes. Because of this limit, though, I actually see it in a better light that because of this limit, those people who can itemize may choose to increase their charitable giving to increase their itemized deductions. Because a lot of the other itemized deductions are subject to a % of AGI. While I've noted here the change in the limit from 50% to AGI to 60%, it is limited. However, really, who gives more than 50 or 60% of their AGI to charity? It's not a very huge number of people. But I think that some people may use it as a tax planning technique to give a little bit more to charity in order to increase their itemized deductions. And that goes along with that last statement on there, P's limitation. So that was the limitation that reduced the amount of itemized deductions that a taxpayer could take once their AGI reached a certain level. So it was for those high income earners. And it was repealed. So therefore, those high income earners or people who can itemize and have a lot of itemized deductions can take a full benefit of those deductions. So I think that could actually help charitable giving. And then I mentioned here athletic seating rights change. So this is for all those MSU fans around this area who give a donation for priority seating to a college or university. If you got priority seating, those used to be 80% deductible still. They assumed 20% was the value of the priority seating that you were receiving. Now those are not deductible at all. So I'm assuming the colleges and universities will try to structure those a little bit differently to be able to still do something in that area. So how can you talk to your donors about the tax law? Everybody wants to make sure our donors are still out there to give to our organizations. So, be direct with your big donors and how it will affect their organization, how it could affect their giving to you. Focus on what did not change. Some of those things are, that they can do, that giving stocks to charities. You can still give gifts directly from IRAs. So a lot of the people who have minimum required distributions can still do that directly to a charitable organization tax-free. Another thing that didn't change is donating to a donor-advised fund. Some planning techniques there could get people over that standard deduction so they could itemize if they wanted to donate a large amount to a donor-advised fund or even just to a charity directly. Be proactive on updating your donors as the federal income tax becomes clearer and more regulations come out and more decisions come out on how these things will affect people. Be proactive if you see a decline in your giving. Communicate your need. Make sure people know what your organization is doing and why you still need their donations. Be a resource for knowledge. A lot of the types of ways that people can give donations is through investments, and make sure that they talk to their financial advisors about and their tax accountant on how they could do that. And really emphasize the mission. Remind donors of the value of your mission. You know, for most supporters, tax incentives are not the biggest factor in making a donation. There was a recent study in 2017 that actually stated 10% of high net worth individuals actually give to charity to reduce taxes. So it's only 10% of those earners. Most other people will give to charity because they want to give to charity, and I want everybody to kind of keep that in mind. So making sure all your donors and the public know what you do is very important. Changes to unrelated business income tax. And if you sat in on my presentations I did last year, I talked a little bit about some of these things that were thought to have changed, and they did. The unrelated business income tax goes under the same rules as a corporate taxpayer. So the previously tiered tax rate structure is now a flat 21% rate. So while that seems like most organizations will get a tax reduction, unfortunately for those taxpayers that in the tiered rate were in the 15% tax rate tier, may now see a tax increase. So we need to keep that in mind for planning. The bucketing rule, it's kind of what I call it. I don't know if that's the right name for it, but we talked about this in the webinars, and this is when you have multiple unrelated business activities. Currently, if you look at the 990T and how it flows, you can merge all of those activities together. So if you have losses with one activity and revenue with another, those go together, and so you could potentially have a net loss, or you can have reduced your revenue in another activity. That's not going to be allowed anymore. So unfortunately, they're probably going to have to do a huge overhaul on the 990T because it just doesn't flow correctly for this new rule. But there's some planning opportunities with that. A couple things, we're going to have to track them separately. We kind of do that already, but we're going to want to make sure we're tracking those separately. And then if you do have multiple activities that maybe one has a huge loss and one has a lot of revenue, you can actually combine those, and maybe it's time to think about creating a wholly owned subsidiary corporation that the organization owns. This is mainly for our associations who have that unrelated business income. There's also a change to the use of NOLs. This is for new net operating losses going forward will now be limited to 80% of taxable income. So this is going to be pretty huge in the corporate world, where if you have a large net operating loss, you will still see taxable income on your next tax returns because it's limited to that 80% of taxable income. And I think that's all I had on that. So now I will switch to Madeline, who's going to talk about some different excise taxes on different types of transactions.
Great, thank you, Brandy. I would say for the excise tax, this is definitely an area we could talk about for well over an hour. And so what we're going to try to do here is really just hit on the main points that you may come across. And so hopefully it goes without saying, but if you do feel you're in a situation where you're close to one of these thresholds, or you would like us to look into your specific situation in further detail, absolutely feel free to reach out to us. To start with, under the Act, an excise tax of 21% is imposed on covered employees of applicable tax-exempt organizations. They go on to define covered employees as it includes any current employee as well as former employees, as long as they're one of the top 5 highest compensated employees of the organization. And so looking, as the law gets underway and time passes, they'll actually start looking back to any preceding taxable year after 1/1/18. So since the law is still so new, really, we're just looking at current employees at this point, but down the road, keep in mind that former employees are also includable in this, this test. So the two main elements there, if their compensation exceeds $1 million, that 21% is imposed on the amount that exceeds $1 million. So if, for example, an executive director is paid $1.2 million, the 21% is only imposed on the excess $200,000. So it's not for the full $1.2 million. Another thing to note is included in that $1 million test is any compensation from related organizations, and it's certainly a gray area right now. We're waiting on additional guidance from the IRS as far as which organization would be ultimately responsible to pay that excise tax. But right now, just being aware that that's included, that's something to keep in mind. So the second portion there is any covered employee who receives excess parachute payments. This particular element doesn't have a threshold, so you're not necessarily looking at anybody that gets paid over $1 million, for example. But there are some further elements to that we'll get into in a little bit more detail. So it's important to start by defining what's included in that compensation of $1 million. It's generally considered to be wages subject to federal income tax withholding. Probably another, I guess, the other major piece to keep in mind is any amount of Section 457F deferred compensation plans that have been vested. It doesn't necessarily matter if it's been received yet or not. The key element there is if the deferred comp has been vested. So those two pieces combined really are the amount of compensation that's subject to that $1 million threshold test. There are, a handful of things that aren't really that are not included in that threshold. It doesn't include non-taxable benefits like healthcare premiums. Typically, if you're used to for your 990 preparation, providing non-taxable benefits or pension payments, things like that, for the Part 7 reporting, that those amounts do not get picked up in this threshold test. It also doesn't include any designated Roth contributions, and it doesn't include payments to licensed medical professionals, and that also includes veterinarians. So it's a very specific area, but those particular professions do not have to worry about paying the excise tax. So going back to the parachute payment, the things that are involved with that, it's again in the nature of compensation, and it's made to or for the benefit of a disqualified individual. Like Brandy mentioned earlier, there are many different pieces to being considered a disqualified individual. And for the sake of time, I won't go into all of them now. But if you do find that these other elements apply as far as the payments made, definitely feel free to reach out to us and we can look into it further. So the payment would also be contingent on a change in ownership or control. And along with the items above, the aggregate present value is at least 3 times the individual's base amount. So to kind of give a picture of what that would look like, if an individual is paid, a salary of say $100,000, and then part of a severance package was paid $300,000 of severance, that might be a situation where there's an excise tax element involved. So, that's kind of the bigger picture of what that is for the parachute payments. So keeping all of that in mind, we do have some planning tips. It's important now to take some time to review existing documents for your highly compensated individuals, as well as their payout agreements, to see if down the line you may have a situation that involves the excise tax. So you can take some action now to avoid paying that tax down the road. Another key element is to avoid separation as the only payout trigger. So to look out for that language in the payout agreements as you're reviewing them. To structure arrangements to be under the $1 million threshold by utilizing other employee benefit plans. Like we previously mentioned, because the 457F plans are included in the threshold, maybe utilizing other retirement plan vehicles instead to avoid, especially if you're close to that threshold, to avoid the tax. And then obviously, as a last resort, nobody wants to give back money that they've received, but consider returning amounts above the threshold to the employer if it's a situation where it's in the best interest of the organization and the exiting employee. If they're willing to get paid the following year and maybe a little bit more, but to avoid paying the tax, that might be something to consider. So moving on to college and university endowments, there is a 1.4% excise tax on net investment income on certain educational institutions. Those institutions are defined as having at least 500 tuition-paying students, an aggregate fair market value of assets other than those used in the exempt purpose of the organization of at least $500,000 per student. So in other words, really looking at schools that have endowment assets of at least $250 million. So that really narrows the scope of the schools affected. And then the last element is that more than 50% of the tuition-paying students are located in the U.S. Given this criteria, it obviously impacts larger schools like Harvard, for example, who has an endowment of over $37 billion. And to kind of give you an idea of how this tax would affect them, they would estimate that they'd have to pay something like $43 million for this excise tax. So it definitely has a very large impact on them. And it's certainly a new large revenue stream for the IRS. While this provision only applies to a select few organizations, it does warrant taking into consideration whether it's starting to set up an unhealthy precedent for the future. It's kind of a newer realm for the IRS to start telling not-for-profit sectors where they should be spending their assets. So it kind of serves as a little bit of a foreshadowing. So hopefully it ends there, but it's something to kind of keep in mind that they're starting to venture into that territory. The taxation of fringe benefits, there's been some changes there. As Brandy was mentioning earlier, the 990T is under the same structure as corporations, and so they are subject to the same rules. And corporations are also facing this new issue as well. So amounts spent on qualified transportation fringe benefits and parking facilities and on-site gyms, those would now be considered unrelated business income for not-for-profits and be reportable on the 990T. And these provisions were enacted to equalize the treatment between taxable corporations that can no longer deduct those amounts. So just to kind of walk through a couple examples of what this means exactly. For commuting benefits, the business tax only applies to subsidies provided to employees. So for example, if the association gives each employee $100 per month to reduce the cost of mass transit and another $100 a month to help with cost of parking, then the $200 per month would be considered UBIT. A different way to structure this, though, is if the association allows for pre-tax payroll deductions for qualified transportation expenses, but no subsidies are provided to the employees, then there would be no UBIT. So if you find this is a situation where you are paying your employees or giving them some sort of subsidy to offset parking or things like that, you would want to revisit structuring this as a pre-tax payroll deduction structure. Finally, some other items to consider, especially pertaining to corporate structures like the 990T or perhaps a wholly owned subsidiary. Entertainment expenses now have been eliminated as a deduction, and so previously a lot of businesses had one account for both entertainment and meals, and they knew that they would, the whole account would be only 50% deductible, but now all for-profit businesses really need to make sure they break up entertainment and meals into separate accounts in order to better track which ones should be deductible at all and which ones are wholly non-deductible. Meals for the benefit of the employer. Previously, they were able to deduct the entire cost, but now there is a 50% deduction limitation for the meals. A couple things with depreciation that have changed. Section 179, the expense limitation has increased from $500,000 to $1 million, and it applies to any property placed in service after 12/31/17. And bonus allows you, it used to be that you were limited to taking 50% of the assets cost as an expense in the year purchased, but now you're actually able to expense the whole amount. So while this seems similar to Section 179, there are a couple key differences. Many states, if you have a state filing, they do not allow bonus depreciation, and so it's actually an add back at the state level. So that's something to keep in mind. And you can use bonus to create a loss for your business, but Section 179 can only break even. So you can only take your income down to zero. There is no loss creation involved with that. Finally, the treatment of interest on advance refunding bonds. The bill repeals the exclusion from gross income interest on bonds issued to advance refund another bond. So interest paid to advance refunding bond investors is now taxable. In other words, the change limits bond issuers to current refundings in order to maintain exclusion for the interest received by bondholders. So that's all we have today. I know we packed a lot of information into a short period of time. So obviously, if you have any other questions, feel free to follow up with either Brandy or myself. And have a great day.